Welcome back. I am getting straight to the point. Imagine we enter a trading app. There are two buttons in front of us, buy or sell. Green or red, it doesn't matter. We know nothing about that asset. We are just going to press a button. If we press a random button, what is our chance of winning? Yes, 50%. So even a child who has absolutely no connection to financial markets will win with a 50% probability when they press one of those buttons. Then, when supported by analysis, this chance should increase even more, right? If your chance of winning is 50% when you know nothing, with a little analysis knowledge, this rate should go up to 70 to 80%. Then why do at least 90% of people trading in financial markets constantly lose their money despite making many analyses and calculations? According to this truth, isn't that child a more successful investor than most people trading in financial markets right now? Brother, you are drawing lines, using indicators, doing research, but with a probability of over 90%, you lose your money in the final. Whereas if you pressed a button without knowing anything, you would have a higher chance. Then there is something wrong somewhere. Let's solve this problem. No product prices itself in financial markets. Where there is money, there is no lack of control or decentralization. That is why the first people you will meet the moment you step into the market are the market makers. The asset you bought or sold, you most likely bought from or sold to a market maker. Playing in the market without understanding the market maker logic is almost the same as playing blackjack. Our chance of winning will be almost the same. Now you will say, is the stock market gambling? No, the stock market is not gambling, but people are very prone to turning it into gambling. You can turn anything into gambling. The market maker's job is to provide liquidity and keep the order book deep against manipulations. But of course, if there is money in the middle, everyone wants to take it. There are three types of investor models in financial markets. First, those who speculate. We call the attempt to make money by analyzing only the price speculation, not trading. I will come to that in a moment. Think of this like sitting at a card game table. The player opposite always sees your hand and can always take the strongest card for themselves. So why don't they use this card constantly? Because you wouldn't sit again at a table where you lose every hand. But a human doesn't want to leave a table where they see they are winning. Because hope is our weak point. These people focus only on price and charts. They trade fast. Usually, technical analysis concepts are used. When I first entered the markets, I did this for years. I used existing concepts. I made improvements. I wrote indicators. Of course, later I realized I was systematically directed here. Speculation is like a straw fire. It flares up fast but goes out one day. Because what is done is betting money on a future probability by focusing only on the history of the price. This is the fastest way to trade, and this is the market maker's favorite investor model. As for the chance of success, quick effects are seen in the short term, but the probability of losing all your money in the long term is almost certain. Let me give you a secret here. Brokerage firms usually don't even transmit the orders of this group to the exchanges, because since it is almost certain they will lose all their money in the long term, they want the money to stay in their own safes. It is very easy to understand who is speculating. They can trade daily, hourly, even minutely. The only way to make too many entries and exits is to move only on price. Especially among our young people aged 16 to 17, futures and Forex have unfortunately become very widespread. In speculation, gains are seen almost every time, but the final does not change. The market maker mechanism works according to mass behavior. Think of it this way. Whichever direction the overwhelming majority takes a position, the price starts to fluctuate in the opposite direction. As I said, your goal is to take a share from the pool in the middle, and so is the market makers. And we cannot detect this only through price. Let's come to the other investor behavior model, trading. I think this is the most misunderstood concept in the markets. Actually, what we call trading is buying and selling merchantry. It is the business of making a profit by focusing on a wider framework, not the price, and using market fluctuations. Actually, one of the oldest professions in the world. Buy for 3, sell for 5. Buying a good cheap and selling it at a better price, or short selling a good, I think is expensive. Trading is actually like managing a commercial company. You have investments. Additionally, you take action in the markets and grow your investments. In this way, an attempt is made to create a wealth that grows cyclically over time. It is not a get-rich-quick business. There is no such thing. On the contrary, it is a growth system spread over time. Trading is like building a house on the ocean shore. Either that house collapses on you, or you build it correctly. One day you go up to its terrace and watch the ocean. There is no other option. Pause. So let's talk about the formula for building the right house. I will explain the method I use. I am explaining the analysis system I developed over the years, step by step. 1. Conjunctural analysis. This is the first analysis to be done before making a decision. What is happening in the world? What are the latest developments? What are the data and future projections in the hands of the Fed, the head of the monetary system? What is the state of economies? What is the debt-income situation? Are we in an expansion or contraction process? Are there bubbled markets? What is the geopolitical situation in the world, etc.? Meaning, primarily through the U.S., the owner of the reserve currency, the political, economic, and geopolitical conjuncture in the whole world is analyzed. In this way, an idea is obtained about what might happen in the future with what is happening now. Just as the conjuncture affects the world, it directly affects financial assets. 2. Historical analysis. What is the average duration of past rise and fall cycles in indices or commodities? Under what conditions did they rise? Under what conditions did they fall? What is the average percentage rate of rises, falls, or corrections? What is the state of correlations? Which conjunctural situation experienced in the past do the current conditions resemble? 3. Fundamental analysis. You have heard a lot about quantitative measurement metrics of a company's financial health using numerical metrics like income, expense, assets, market cap, book value, price-to-earnings ratio, etc. But here I want to touch upon a misconception about fundamental or quantitative analysis. Metrics like P/E ratio or market cap/book value have an importance, but in my opinion, it is less than assumed. For example, a company's 20-year earnings are already reflected in the stock value. But with this logic, there are those where 100 years are reflected too. Future projection and the quality of the company or commodity is a big variable. If we look at a good with today's conditions, we can see very different figures, and this can be misleading. But if we consider the future potential of what is being priced, things change there. At this point, what is important for me is the market value of the company or commodity and the valuation differences between rival companies or other markets. And here we move to a very important analysis that saves us. 4. Qualitative analysis. Brother, this is perhaps the most important of all I have listed so far. There are no numbers here. Let's go through a company. For example, Apple. Recently they say, will Apple become Nokia? That's where it came to my mind. Who are the company managers, investors, and partners? In which countries does it operate? What are the products it produces? What are the company's strategy, patents, and innovations? What type of products has it produced and sold in the past? How successful was it in this? What is its importance for the country it is in or the world? Industry standards, customer base, market power? Look, there are so many questions. By the way, Apple won't become Nokia because Apple is not that simple of a company. Or for example, if you examine Intel's performance in past quarters, you might think the company could go bankrupt. But if you examine its quality, you will see that such a thing is not very possible. Let me put it simply, Intel equals America. If you wish, I can even make a detailed video about these two companies. If we go through a commodity, what is the sectoral usage purpose of this commodity? For example, like gold, are there different usage purposes among people? What is the frequency of usage in industrial products? Or central banks continue record gold purchases? Okay, but what is the meaning of gold for central banks? Look, there are so many questions. The thing being tried to be understood is to draw a result about that product not numerically, but qualitatively. Usually, your probability of making money in a company or commodity whose qualitative analysis is done correctly is very high. For example, before investing in a company, if possible, I want to use and see the product it produces. This could be an airline company, a website, a food or different product manufacturer. It doesn't matter. Even for companies that do not directly produce end-user products, I look at who the buyers are, for what purpose it is used. For example, it produces an industrial product. Then who are its customers? What is its place and importance in the sector where its customers are? Qualitative analysis makes you ask a lot of questions and gives us the most detailed ideas possible about that good or company. I want to state my own perspective here. I think qualitative information is more important than quantitative information in financial assets. 5. Psychological analysis. This is the second to last hole of the flute. A company or commodity price can be very cheap, but we have two problems for the price to move. A product where too many investors are waiting inside does not move easily. Because a person who bought from the bottom is also a person who has the potential to sell from the top. In such a case, since the liquidity in the hands of the market maker will decrease, this does not suit anyone's business. The other reason, brother, there is money in the middle. You and the market maker put this money on the table. Both of your goals are to take each other's money, meaning since money doesn't rain from the sky, either you will win or them. There are those who think market makers are human. What we call a market maker is a system. Yes, humans also work inside, manage the order book and algorithm. Especially on the future side, what we frequently see is that when the mass takes a position in the same direction, the market starts moving in the opposite direction. This is actually the same in the spot market. When too many investors accumulate inside, sharp movements can come to convince those investors to sell, or it can be kept at the bottom for a long time. That is why it is usually more profitable to be contrary to the majority. Look, I will give a very simple example on this subject. Think of your neighbor. He is a hardware store owner and normally has no interest in the stock market. If this man sits and talks about the stock exchange, or when you go to the industry zone and the master talks about a stock, there is definitely something wrong. Brother, money hates noise. If there is too much noise somewhere, it means the bubbling process has started there. 6. Technical analysis. Here we come to the finale. This is the place where people think they can make money by skipping all other sections and directly doing fast trades. Actually, the importance of technical analysis for us is this. We now have a perspective in the 5 analysis types we have done so far. In technical analysis, we enter a price search to make our buying and selling with maximum profit using support, resistance, trends, and patterns. Meaning, we don't make the decision through technical analysis. We already largely made the decision. We analyze the price, looking for correct entry and exit points. We use patterns and trends to confirm our plan. We use support and resistances for entry and exit purposes. But we don't make a decision only through technical analysis. The moment we do that, we have speculated. Final stage, interpretation. In these 6 stages, we now have general information. After this, everything is up to your interpretation. This is where the real issue begins. This information is open to interpretation. After all information is brought together and blended, the perspective determines the final decision. And our perspective is determined by our ideas about the functioning of the monetary system and our market experience. That is why the thing more important than all analyses is interpreting. If we take two professionals while mastering the same data, one can decide A and the other B. For example, last week I said something like this: although we are in an interest rate cut process, I expect new peaks in the S&P first, followed by a very sharp correction process with an excuse in the coming months. But a colleague told me he thought exactly the opposite. Yet we are both analyzing the same data. Here the difference in interpretation emerges. Everyone is looking for a magic formula. Some try to do this through technical analysis or price action, which is very common in recent years. Exchanges especially support this. In this way, people do these without thinking that every trade they make has a risk of losing, and many trades have a risk of losing much. There are even many people emailing me saying, "I lost a lot of money, tell me a strategy." Unfortunately, it is time to speak the truth. There is no magic strategy or formula. Seriously, there isn't. Look, hundreds of millions of people in the world are looking for this. Whereas the truth is this: stock exchanges are the recycling mechanism of capitalism. It is one of the most effective ways for the extra money we don't use to return to the functioning market. Our money sitting on the side has no benefit to the system. In the capitalist production model, the only way for the money released to the market to be productive is for it to stay inside the market. Because that money is released not for us to put aside, but for us to use and keep the economy alive. Meaning money exists for us to spend it. Money is actually a debt note. That is why M2 money supply is very important. Anyway, we will talk about this subject another day. Think of trading like building a house on the ocean shore. If you drive piles into the forum and build a foundation on it, you get a strong hold. This is conjunctural analysis. If you calculate when it will rain or when the water will rise based on past movements, this is historical analysis. In this way, you calculate when the storm will potentially break out and how long it will last. You start construction accordingly. You don't get miserable. If you calculate whether a single story, 2 stories, or a triplex can be built from the material in the middle and start construction like that, you know it won't be left unfinished and rain won't fall on it. Because if you build the second floor and can't build the roof, that house floods in the first rain. This is fundamental analysis. The metric where you decide how high quality the material you will use is, how long it will last, and whether you will build the house there or at a more predictable point 500 meters ahead, is qualitative analysis. You decided to build that house, but if tons of people also decide to build a house on the same plot, you cannot find peace and cannot shelter. This is psychological or perceptual analysis. If you find quality material and workmanship at an affordable price and start construction, it becomes easier for you to proceed to the end. This is technical analysis. Finally, the roof. The roof is interpreting. If the interpretation is not correct, since the construction you made will constantly take water inside, it makes your house unlivable in the long run. And building that house not on the beach, but 500 meters back, and enjoying it without getting too involved with the ocean is called investing. Waves do not concern the investor. He watches the view. By the way, I have become quite like a constructor. I dealt with housing business a lot recently. It might be because of that. Of course, I will also explain the formula for coming out most profitable through market experiences and investor analyses in my own way. First of all, speculating is no different from gambling. I do not recommend anyone to do it. Very clear. Instead of repeating the reasons and swelling your head, I will make a detailed video about the subject. The second subject to pay attention to: who should trade? Brother, you have money on the side, or you have a medium and above income. Think like this. For example, you have 5 million on the side. We turn at least 70% of this into a long-term portfolio. I think 80% is ideal. With the remaining 20%, we build a trading portfolio where we will look for buying and selling opportunities in the short term, meaning under 1 year. What does this do? The main goal is to make the long-term portfolio even stronger. In this way, we want to accelerate the wealth creation process. Meaning, trading is not a way to get rich quick. It is a way to strengthen investments and accelerate acquiring wealth. Therefore, only people who have reached a certain saving size or have medium and above income can use this way. Because trading contains risk, and it would be more correct for a low-income earner or a student not to trade and take risks, but to invest and focus on the growth of their investments. Finally, who should be an investor? Everyone. Yes, investment is the worker sleeping in our pocket. When we direct this correctly, that worker brings much more than we work and ensures we acquire wealth. That is why investing is the most important level of all financial behaviors. Especially low-income earners or students must definitely be investors. Those dreaming of getting rich by making daily trades from their phones do not know the system facing them. I am saying it very clearly. Right now, a credit card and loan explosion is happening in the local market. We have come to such a point regarding repayments that there is a huge crowd especially attempting to trade unconsciously in the stock market and acting with the hope of making money from this. Almost all of them constantly lose money, and they also attempt to lynch those who insist on this path and warn them. Especially those investing their money in short-term trading information received anonymously from the internet are too many. But mass movements always bring harm. That is why information has to stay in a limited area. 1,000 people buying a product versus 100,000 people buying it affects the entire price movement. As the mass grows, it becomes the target of market makers. Therefore, sharing a short-term trading transaction anonymously gives harm, not benefit to people. The biggest example of this happened in the crypto market and the local exchange in the last 4 years. Look, over 10 million people are waiting sunk. The reason is investing in anonymous information they receive from social media or popular products they saw in forums. But still, I see a huge crowd insistently trying to do the same thing. There is a sharp rule I gained as experience over the years in markets. No one can make money from what everyone knows. If there is interest and support for this video, next week I plan to prepare a video for low-income earners and students on how they can grow their assets. There is no such thing as getting rich quick, but by going with time and the right path, one day you can definitely come to the point you want. Take care of yourselves. Thanks for listening.